Are Trump's new tariffs making it harder to attract guests to your short term rentals? Early 2025 data shows a sharp drop in Canadian and European visitors to the US, and fewer Americans heading abroad as well. These shifts, driven by trade policy, inflation, and traveler sentiment, are creating real uncertainty across the short term rental industry. In this video, we'll unpack what's happening, why it matters, and what you can do now to stay ahead, whether you're managing properties in the US or catering to American travelers overseas. Hi, I'm Yuvika Wahi from Rental Scale Up, your go to source for short term rental news, data insights, and strategic guidance. Each week, we dig into platform updates, policy changes, market data, and guest trends to help professional managers like you make informed decisions that drive performance. Let's start with the data. In March 2025, overseas visits to the US dropped by 12% compared to the same time last year, according to Cleveland Research. Canadian travel to the US fell by roughly 23%, which is a significant blow to key cross border markets that rely heavily on road trips and seasonal visitors. Mexico, interestingly, is the exception. Visitor numbers remain stable, continuing a strong recovery from 2024. On the flip side, Americans are also pulling back on international travel. Outbound travel growth has slowed down to just 0.7% in early 2025, down from 8% in late 2024. So people are still traveling, but they're staying closer to home. The question is, what's causing this shift? Let's start by talking about one of the most important but often misunderstood factors behind the slowdown: tariffs. In April 2025, the Trump administration enacted a sweeping round of new tariffs that pushed average import rates in the US to nearly 30%, according to Tourism Economics. While tariffs may sound like a business issue for manufacturers, they're already impacting both the cost of running a rental and the behavior of the guests who book them. For starters, they are shrinking household spending power both in the US and abroad. According to the Yale Budget Lab, these tariffs function as a regressive tax. The average US household is projected to lose around $3,800 in spending power this year, with lower income families seeing a reduction closer to $1,700. And while the numbers focus on Americans, similar pressures are building in key source markets. In Canada, for example, rising inflation, economic uncertainty, and a weaker currency are already squeezing households. Add in trade tensions and discomfort around US policies, and travel to the US becomes not just more expensive, but more complicated and less appealing. This helps explain the sharp drop in Canadian arrivals this year. In Western Europe, we're seeing the same pattern. The euro and the pound have weakened, inflation is high, and airfare is costly. On top of that, some travelers are uneasy about the US's current global positioning. The UK, which had shown early signs of growth in 2025, saw a 14% year over year drop in March alone. So while tariffs aren't the only factor, they're amplifying existing affordability challenges and travel hesitations. Second, tariffs are driving up costs for property managers. If you've had to replace linens, furnish a new unit, or restock electronics, chances are you've noticed the price hikes. Tariffs on imported goods hit operators directly, increasing overhead just as guest spending is getting tighter. That's why these policies matter to short term rental managers. They increase pressure on both sides. Guests have less to spend, and hosts are paying more to deliver the same experience. And beyond economics, perception plays a big role here too. Some international travelers are expressing concerns about US's immigration policies and border control practices. Others are wary of the broader political climate. Even if the trip is affordable, some families, especially first time visitors, may choose to avoid destinations that feel uncertain or unwelcoming. This is sentiment, not math, but it shapes booking decisions just the same. To add another layer to the mix, the US economy is cooling. Oxford Economics now projects GDP growth slowing from 2.4% to 1.7%, with core inflation climbing. This affects the domestic side of your business too. The travelers who might otherwise be filling the gaps left by international guests may also start making more conservative choices. So, what does it all mean in practical terms for short term rental managers? If you operate in an international facing market like New York, Los Angeles, Orlando, or a major resort area, you're likely to see a slowdown. These destinations often rely on international guests for 20% or more of their bookings, and when those visitors pull back, you may notice gaps in your calendar, slower booking velocity, and more pressure on nightly rates. You may also see your performance on certain platforms shift. Booking.com, for example, has a higher international mix, around 30% of its US bookings. If that share dries up, you may need to diversify your OTA strategy and shift more towards platforms that have stronger domestic demand. On the other hand, if you operate in a drive to or domestic heavy market, Think the Florida Panhandle, the Smoky Mountains, or Central Texas, you may be better positioned to capture new demand. Americans who are not traveling abroad still want to travel somewhere, and regional markets offer convenience, affordability, and ease. But here's the catch: just because domestic demand is rising doesn't mean guest budgets are. Guests may be booking shorter stays, they may be skipping upgrades, comparing options more closely, and choosing based on value. So while the volume might be there, the spending habits may shift. Let's dig deeper into that domestic shift for a second. In early 2025, outbound US travel slowed dramatically from 8% growth in late 2024 to just 0.7% in early 2025. That means more Americans are staying home, and many of them are turning to local getaways. This is a clear opportunity for regional markets within a few hours of metro areas. But again, it's not a return to pre 2020 vacation behavior either. The average traveler is cautious. Spending power may be down. And as tariffs raise the cost of goods, even high income households may become more selective. Instead of week long summer vacations, you might see 3 or 4 night bookings. Instead of premium upgrades, guests may prioritize flexible cancellation, free parking, or a great kitchen over fancy amenities. You're not just competing with other rentals, you're competing with staycations, hotel reward programs, and day trips. To adapt, pricing and messaging will need to be aligned with guest expectations. That means emphasizing value, ease, and reliability. So, what can you actually do right now? If you're US based, focus your messaging on domestic travelers. Update your listings to highlight convenience, comfort, and drive to accessibility. If you're within 4 or 5 hours of a metro area, say that clearly in your descriptions. Look at your vendor relationships. Can you lock in pricing before the next cost jump? Can you renegotiate terms? Even small savings will add up if bookings flatten out. If you're managing properties outside the US that rely on American guests, it's time to adjust your offers. Americans may still travel internationally, but they'll need a strong reason to do so. That means highlighting ease of travel, safety, and strong value. And finally, reassess your platform mix. If your performance is dipping, it might not be your property, it could be your OTA. Airbnb and Vrbo tend to pull more domestic demand in the US, while Booking.com is more exposed to the international slowdown. Stay flexible, stay visible, and make sure to keep an eye on your booking data. 2025 may not be what we expected, but it's not unmanageable. If you've been in this industry for a while, you've already weathered massive shifts, pandemic pivots, regulation waves, platform changes. And like before, the operators who adapt early will come out stronger. The international market may recover. If it does, you'll be ready. And if it doesn't, you won't be caught off guard. Thanks for watching. For more weekly data and insights, subscribe to the Rental Scale Up newsletter. It's free, it's weekly, straight to your inbox, and will help you stay one step ahead. Bye.